Futures and options. What is the difference, and which investment should you choose? Let's take a look at what the folks at TD Ameritrade had to say about futures contracts.
A futures contract allows traders to speculate on the price movement of commodities, currencies, stock market indices, and other assets. Buying futures is different than purchasing a stock or an option. When you purchase a futures contract, you do not need to make a large payment up front. Instead, you are required to keep money in your account to fulfill the margin requirement. The margin requirement is only a small percentage of the value of the underlying asset. It's intended to be enough to cover the likely maximum one-day loss from changes in price to the value of an asset specified by the futures contract. At the end of each trading day, this money is used to settle any gains or losses made from your investment. For example, suppose a trade moved against you one trading day. At the end of that day, money would be removed from your account to cover the losses from your futures contract. If the loss was significant and enough money was removed that your account no longer had enough cash to cover the margin requirement, then you would be in a margin call situation. What happens during a margin call depends on your broker. You may be required to deposit additional funds to cover the margin, or your trade will be automatically sold. With a futures contract, a small investment can lead to big profits or big losses. This is because a futures contract is a leveraged investment. In investing, leverage is the ability to control a large amount of money with a small investment. Futures contracts are highly leveraged. Because of this, small changes in price of the underlying asset have a much larger impact on a futures contract. This is one reason why investing in futures is much riskier than other investments. Because prices can move quickly, futures trading is only for active investors. In fact, most futures contracts are bought and sold on the same day. Unlike the stock market, futures markets are open virtually all hours of the trading week, allowing traders to buy and sell futures contracts around the clock. If you're a more casual investor who only buys or sells a few stocks every couple of weeks, futures trading may not be for you.
What they had to say about options contracts.
Options trading is an alternative way for investors to invest in the performance of a security, such as a stock or an ETF. By trading options, an investor can capture the up or down movement of a security while only investing a fraction of the cost it would take to own the actual security. The pricing of options is very complex, which is why it's important to educate yourself about options and their risks before you invest. While the biggest change comes from the price of the stock, ETF, or other investment vehicle that the contract represents, there are other forces like time decay and implied volatility that influence options prices. Options can be used in a variety of ways. There are call options, which we just saw, that are good to own if the price of a stock goes up. And there are put options, which are good to own if the price of a stock goes down. Calls and puts can also be combined in a variety of ways. By buying and selling these options, investors have the potential to make money when the market moves in any direction.
Let's summarize. Futures contracts allow the investor to speculate on commodities, currencies, stock market indices, or other assets. Options, on the other hand, allow the investor to speculate on stocks or ETFs. And then the option pricing is affected by 4 variables: the stock price, time decay, implied volatility, and the interest rate. And options come in 2 formats: the call option, that may permit the investor to profit if the investor sells his or her positions when the security price is above the strike price. The put option, on the other hand, the investor may profit when the investor sells his or her put position at a security price below the market price or the strike price. This video is for educational and example purposes only. The video in no way implies that you will make money. Trading futures and options carries a risk of loss of any or all of your capital. The only advice is to seek the assistance of a certified investment advisor for your investment consultation.